Are you in your 50s or 60s looking for investment opportunities that will ensure a reliable source of passive income to help fund your lifestyle once in retirement? We all know that there has been a decades-long retirement crisis going on. Roughly half of people say they don't have enough money saved to maintain their standard of living once they stop working, don't even have retirement accounts, and will have to rely on Social Security for most of their retirement income. But what if I told you that there was an easy way for you to create your own safe and reliable passive income to help fund your lifestyle? Look no further than high-yield dividend blue chip stocks. These investments can offer dividend yields that are more than triple the amount of the S&P 500's 1.45% dividend yield, with proven dividend growth histories with no signs of stopping anytime soon. While younger investors might be better suited for lower yield but higher growth dividend growth companies due to benefits of compound interest and dividend reinvestment, people closer to retirement age simply don't have the luxury of time. What they need are current high yield but stable companies that will pay them consistent dividend income that will outpace inflation and help fund their retirement. Hey guys, this is Nick with Nick Does DGI, and welcome back to my channel. In today's video, I'm going to go over 3 potential blue chip dividend stocks to consider for your portfolio for passive retirement income. Don't forget to hit that like button, and let's get started. The first stock I want to talk about is ticker symbol T, AT&T. AT&T is a massive conglomerate that provides telecommunication, media, technology services worldwide through its communication, Warner Media, and Latin America segments. This stock, with a market cap of $224 billion, trades for around $31 and offers an impressive dividend yield of 6.62% as of this time of recording. AT&T is a dividend aristocrat, meaning that the company has grown its annual dividend for at least 25 years and has done so for 36 consecutive years. AT&T currently pays a quarterly dividend of 52 cents every February, May, August, and November, with a total annual dividend of $2.08 per share. While its dividend growth rate is nothing to brag home about, rising at just 2% annually, a dividend yield of over 6.5% will outpace the rate of inflation and help pay for your bills. Yes, AT&T has in recent years increased its debt load due to good and bad acquisitions like DirecTV and Time Warner, and that has some investors worried. Nevertheless, the dividend looks safe and secure for the foreseeable future. Despite a global pandemic, the company's full-year free cash flow was $27.5 billion, while paying out $15 billion in dividends, making its free cash flow total dividend payout ratio for the full year of 2020 at 54.5%. Looking forward, it expects modest revenue growth and stable adjusted EPS, and the dividend payout ratio remains in the 50s%, ensuring flexibility for further dividend increases. Looking at the 10-year yield on cost for AT&T, which is essentially the current dividend yield based on your original investment and future dividend increases factored in, it comes out to 6.78%. While not exactly spectacular, I consider this stock to act as a bond substitute while receiving preferential tax treatment on the qualified dividends. Best of all, AT&T might be undervalued in the midst of an overvalued stock market. The stock is rated 4 stars by Morningstar with a fair value estimate of $36, indicating a 14% upside. The second stock I want to talk about is ticker symbol MO, Altria Group. Altria Group Incorporated, through its subsidiaries, manufactures and sells cigarettes, oral tobacco products, and wine in the United States. This stock, with a market cap of $87 billion, trades for around $47 and offers a respectable dividend yield of 7.26% as of this time of recording. Altria Group is a dividend king, meaning that the company has grown its annual dividend for at least 50 years and has in fact done so for 51 consecutive years. Altria Group currently pays a quarterly dividend of 86 cents every January, April, July, and October, with a total annual dividend of $3.44 per share. Considering its dividend growth history, this company continues to grow its dividend at a respectable rate with a long-standing policy to target a dividend payout ratio of approximately 80% of adjusted diluted EPS. The 5-year dividend growth rate was 9.08%, and its 10-year dividend growth rate was 8.66%, indicating the management's ability to find new avenues of growth and prudent financial management. Let's talk briefly about the elephant in the room, which includes investor sentiment and investing in quote-unquote sin stocks, regulatory headwinds, and secular declines in traditional tobacco usage. There's no question that the amount of cigarette smoking has trended downwards as alternatives like vaping/e-cigs came onto the market, and governments are willing to place additional regulatory limits or restrictions on advertisements and nicotine levels. That being said, Altria Group is more diversified than you might think. Altria Group is currently launching its next generation of e-cig devices called IQOS that heats up and not burn the actual tobacco, as well as expanding into the wine segment through its St. Michel Wine Estates subsidiary. In strategic investments, Altria Group holds a 10% ownership in Anheuser-Busch to gain exposure into the worldwide alcohol industry, a 35% in Juul Labs, one of the largest vaping companies, and a 45% in Kronos Group, a rising star in the retail cannabis sector. Despite these headwinds, time and time again, from the 1998 Tobacco Master Settlement Agreement to renewed concerns of regulatory restrictions regarding the teenage use of vaping and tobacco limitations, Altria Group has managed to reward its shareholders in both consecutive dividend growth and share price appreciation. And your 10-year yield on cost for Altria Group is an incredible 13.2%. If you can get past a personal hurdle of investing in a sin stock, Altria Group will be more than glad to finance your retirement bills with sweet dividends. Likewise, the stock is also rated 4 stars by Morningstar with a fair value estimate of $54, indicating a 12% upside. Third and final stock I want to talk about is ticker symbol WPC, WP Carey. This stock, with a market cap of $13 billion, trades for around $73 and offers a solid 5.7% dividend yield as of this time of recording. WP Carey is 3 years away from achieving a dividend aristocrat status, having raised its dividends for 22 consecutive years. Ranking among the largest net lease real estate investment trusts or REITs, WP Carey has a diversified portfolio of over 1,200 high-quality single-tenant industrial, warehouse, office, retail, and self-storage properties located primarily in the United States and Northern and Western Europe. WP Carey currently pays a quarterly dividend of $1.04 every January, April, July, and October for a total annual dividend of $4.19 per share. Using adjusted funds from operations, or AFFO, which is a preferred ratio for REITs, we can see that the dividend payout ratio is at manageable levels. Anything under a 90% payout ratio is acceptable, and you can see that the payout ratio in 2020 was 88%, with this figure expected to decline to 86% in 2021. As with any high-yield blue-chip dividend growth stocks, we want to ensure that the company is able to weather any economic turmoil that might appear in front, and the pandemic's effect on real estate was a prime example. In large part, we saw huge retail tenants like movie theaters and fitness centers close business for months, and as a result, other traditional retail REIT peers saw their rent collection rates plummet into the 50s and 60%. However, thanks to its emphasis on industrial warehouse and self-storage tenants, WP Carey's worst month in rent collection never dropped below 96% even at the height of the pandemic. A year later, WP Carey managed to collect 98% of their rent due in March 2021, with most of their property types paying full rent minus the fitness, theater, and restaurant category being the sole exception. Fortunately, only 1% of their entire portfolio is in this category, so it is negligible at this point. And your 10-year yield on cost for WP Carey is a respectable 11.84% while becoming a part-time landlord with exposure into the commercial side of real estate. WP Carey looks to be currently fairly valued. That being said, a 5.7% dividend yield is not a bad starting point. Not only will you take advantage of predictable and stable dividend increases, you'll also reap in one of the better performing REIT stocks in the market. Since going public in 1998, WP Carey has significantly outpaced the key REIT indices as well as the S&P 500. If you would like to know more about this company and why I like REITs in particular, I have made a separate video which I will leave a link in the top right corner to view afterwards. I hope these 3 stock suggestions have given you a starting point on your journey to financial independence and wealth building. Even in a historically overvalued stock market, there are still hidden dividend income producing gems to be found and utilized as part of your investment strategy in paying your bills in retirement. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take the information with a grain of salt. Please do your own research and due diligence when deciding to invest in investable securities. If you found this video helpful, please consider clicking the like button and subscribing to my channel. Hit the bell notification to receive an alert on all the newest videos. The YouTube algorithm likes these sorts of engagements and helps my channel get shown on more homepages. Until next time, take care.